Hello, Financial Future family. Welcome back to another exciting episode on our channel. Today, we're delving into the intricate world of taxes on stocks, tailored specifically for beginners in the stock market. If you're navigating the financial markets, understanding the tax landscape is crucial. So, let's explore how to leverage tax rules to your advantage. Firstly, I want to guide you through managing your finances in the stock market, covering aspects such as gains, losses, dividend income, and interest income. We'll also discuss strategies to minimize your tax liabilities. If you have any advanced questions or need clarification on today's topic, feel free to drop them in the comments below, and I'll be here to assist you. Let's kick off with the basics. In the stock market, your taxes are based on the calendar year, spanning from January 1 to December 31. Your brokerage account will meticulously track all your activities throughout the year, including gains, losses, interest, and dividends. As we approach the end of the year, your brokerage account has until February 15 to furnish you with a crucial tax document known as the Consolidated 1099. This document encompasses the 1099, detailing your gains or losses, the 1099, reflecting interest income, and the 1099, outlining dividend income. While it might seem surprising that these documents aren't available immediately on January 1, it's due to certain stock transactions that can retroactively impact your taxes, such as the wash sale rule. Now, let's dive into the tax implications of gains and losses in the stock market. If you make a profit, you'll incur taxes, but the silver lining is that if you experience a loss, it can result in a tax deduction. The duration you hold the stock matters. Holding for 1 year or less categorizes it as a short-term capital gain, subject to regular tax rates. However, holding for over a year designates it as a long-term capital gain, offering more favorable tax rates. To illustrate, let's say you buy Tesla stock for $100 in January 2023, sell it for $120 in February, making a $20 gain. Your tax on this gain depends on your tax bracket, ranging from 0% to 37%. Long-term capital gains, held for more than a year, enjoy even better tax rates. Remember, triggering a tax consequence occurs only when you close your position. If you continue to hold the stock without selling, you won't incur taxes. Now, let's discuss the positive side of losing money in the stock market: the tax deduction. While losing money is never the goal, if it happens, the IRS provides a tax deduction to ease the financial hit. I'll walk you through 3 scenarios, explaining how losses can be utilized to reduce your taxable income. Moving on to dividend and interest income, around early February, your brokerage will provide the Consolidated 1099 tax document, detailing the income generated from dividends and interest for the previous tax year. Reporting this information on your tax return is straightforward, and modern tax software often allows direct integration with your brokerage accounts. In summary, stay vigilant for your tax documents, use them wisely, and always be mindful of the potential tax benefits in both gains and losses. If you're just starting or if you have any questions, drop them in the comments below. Your journey to financial wisdom starts here on Financial Future. Thank you for your continued support. Don't forget to subscribe, and I wish you all a prosperous day ahead. Take care.